Well, greetings and welcome to the investment strategy brief for February 2026. Well, artificial intelligence is everywhere. There's so much optimism around this capability. It creates opportunities, it creates some risks, and what we're going to talk about a little bit during this session is it's creating some fears as well. So let's jump in. Now, remember that we started the year about a month ago or so with our Outlook report, Rewiring Growth, so I invite you to check it out. A bunch of different articles that get into things like artificial intelligence, geopolitics, all that. We're going to get into some of this today. And then, of course, our outlook for the year, which we'll recap again in this episode. So jumping in to politics and geopolitics, Brian Gardner, Chief Washington Policy Strategist here at Stifel, penned his article for his 2026 outlook in D.C. midterm election year that it is, and this coming year. And basically, Brian got into a number of things that are sort of going to drive the environment from a DC perspective. We've got the midterms, the potential of a change in leadership in terms of maybe moving to divided government if one of the houses moves from Republican to Democratic control. Sort of in focus for everyone is where the economy is going. It's looking pretty good, actually, but also affordability. And then the tensions around trade, tariffs, and things like that. We've seen change at the Federal Reserve that's upcoming. And so, again, Brian did a great job penning that out. But I would say, despite all the energy, right, there's a lot of media, a lot of noise, things have actually been relatively stable. And net, I'd say the administration's policies are a little bit stimulative. Now, this is against the backdrop of an environment more broadly around the world, geopolitical risks and tensions. And so we updated our dashboard, as we always do in the Outlook report. And it gets into all the different kinds of risks that we're monitoring for as it relates to geopolitics. And there's tensions out there, obviously, around trade, and we have to worry about misbehavior and various other kinds of risks. We did break out, as I've mentioned a number of times before now, military conflicts into their own section. And so we've seen, sort of flare-ups and issues, but as it relates to the global economy and the markets, nothing that has been super disruptive. But again, we monitor what's happening and the potential for what could happen against that backdrop. Now, moving on to the economy, and I mentioned the idea that things are looking pretty positive. So we've moved back modestly above trend growth when we look at the full century in this century. So since 2000, we see the drop seems so dramatic at the time for the financial crisis, and then the bigger drop in a way for the shutdown and reopening of the economy around the pandemic. But ultimately, what we've seen is some pretty robust growth. One of the drivers of that is the consumer. So the consumer's confidence and sentiment measures have drifted down, as we've talked about. We're seeing a little bit of a burden on increased interest rates, therefore increased cost of debt. We've seen a job market that is pretty good, and we'll get into this, but softening a little bit. Now, that's against, anyway, all that is the backdrop against sort of consumer activity, and retail sales is certainly a good metric for that. What we've seen is volatile but generally positive numbers when it comes to retail sales growth. And again, the consumer has been a driver of the economy. Now, the job market, as we said before, is softening a little bit, meaning that there are fewer jobs open. We're kind of in a no hire, no fire environment, but we're kind of close to full employment. So unemployment rate is below that which we saw for the 10 years before the pandemic. It's certainly below that which we saw during the reopening. But what we're seeing is sort of job creation slowing down a little bit, the jobs that are being offered slowing down just a little bit. And yet we're close to full employment. So softening, but still a pretty good labor market. Now, another factor that comes into focus for the Fed, for example, is inflation. So another storyline here is that inflation has cooled down really close to the Fed's 2% target in the last number of months, but not all the way there. And the Fed remains focused on that. They're going to talk about that. So think of it as the job market holding up okay. Inflation cooling, but not all the way down to where they would claim victory. And then against all that as a backdrop, we have the nomination of Kevin Warsh as the next Fed chair. So we've talked about this before, but basically he's got a hawkish reputation. He's got a history of wanting to see sort of closed debate and yet then transparency and accountability for how people vote. And yet, he ultimately didn't descend didn't have a dissent vote when he was on the Fed earlier. So all this is pointing to the idea that here's a person with experience and sort of these interesting concepts of wanting there to be good debate, but ultimately I think consensus in terms of where things head. In any event, the only other thing I'll note is his expressed discomfort for the size of the Fed's balance sheet. It's sort of known, at least by his historic practices, that he prefers to have the interest rate be a primary driver of policy. So all of this will be against a backdrop, number one, for his approval, but secondly, if he is ultimately in the seat, how does he guide what really is still a committee through a process to continue to manage monetary policy? So that'll stay in focus. Futures didn't move much in the wake of his announcement, meaning that essentially there's an expectation from the market that we'll see 2 cuts later this year, 1/4 point each. That's in line with our outlook. And that sort of timing and magnitude as he was announced didn't really move a lot. So that's an interesting sort of market data point. Now, another thing that we keep an eye on, of course, is fiscal trajectory. We talk about it every single month, and this is the idea that we see increased or sizable deficits, increased debt, and those two things together are kind of challenging as we look into the future. So the idea that almost $2 trillion a year or $2 trillion plus or minus on top of the current debt is an issue. And so, as I mentioned last time, we penned an article about this in the Outlook report, Fiscal Trajectory Borrowed Time, where we walk through 4 different scenarios. But the two sort of end tails of the scenarios, on one hand, is the optimistic one, which is to say, hey, a little austerity, maybe a little less spending, and maybe growth and a little more revenue, and maybe a little bit higher taxes, grow our way sort of out of it. And that's the most optimistic sort of view. The most pessimistic is that there's basically a reckoning that at some point we're going to have to see a major economic correction to kind of deal with the fact that there's this instability that's growing. And again, I've talked to a few experts today even. We think it's a number of years out, but there needs to be sort of a resolution to this issue or there will be trouble down the road in our view. So again, we'll keep an eye on that. Now, one thing that we've talked about and we've written about is gold. Gold has moved up a lot. People look at it as an alternative store of value, and in one of those cases, it's an alternative to buying treasury bonds. So if you think about treasuries as being held out as the risk-free asset, well, now with increased debt in the U.S. and a modest downgrade in the credit rating of U.S. debt, basically some people might be saying, hey, either number one, I want to get paid more to hold this bond, and that can bring up treasury yields and interest rates, or number two, I'm going to pull my money out of the bonds and I'm going to put it in something else. And that something else is, some people are saying, is gold, and that demand for gold is partly what's driven the price up from here, that sort of seeking of an alternative store of value. So again, keeping an eye on it. We think it's, in our view, a little bit overdone. We're not really traders, if you will, but ultimately, in this slide deck, if you get a copy of it in the link here, what you'll see basically is an article where we unpack exactly what happened in our views looking forward. Now, moving back to the economy, so that is a backdrop that leads us to understand that basically there's increasing optimism amongst economists to the tune where we saw that at the start of the year, the consensus view for GDP growth in 2026 was 2%. That's moved up to 2.4%. So everybody's sort of ratcheting up their forecast for this year under the observation that the consumer remains engaged and business spending remains active. And so that's obviously a positive, right? Sort of the opposite of worrying about a recession. In any event, that sort of leads me to a reiteration of our outlook for the year when it comes to the economy, where we said, hey, we think the economy is going to likely grow above trend. We kind of penned a range 1.75% to 2.5%. We think it's in the upper half of that range is where we think things are, and the consensus has kind of come to that view. We see inflation cooling, but not all the way to the Fed's 2% target, and that gives us the opportunity to switch gears and take a look at equities. So we'll dive into some of the details again, but think of it as a modestly positive view looking forward of 10% for the year on the S&P 500. So turning to the markets, and we'll get into both bonds and stocks. We start with fixed income or bonds. Interest rates remain elevated. The yield curve has normalized. The 10-year, which is sort of the bellwether yield everybody watches, seems kind of range-bound and down just above 4%, and a decent place to be in my view, but not a lot of volatility, which is good. And in fact, when we look at yields on bonds, they remain very attractive across the various asset categories or bond categories that people tend to invest in. And one of the things we track is sort of the volatility of the bond market. It's called the MOVE index. And basically, we're sitting a little bit below long-term average. So we had a little bit of a spike in volatility last year, but it's calmed down a little bit. And we see that day to day in the markets for sure. In any event, fixed income has become sort of a popular place to be, again, both for that yield and the diversification effect they tend to have against equities. Now, turning to equities, we looked at this last time, but it does tell the story of where we've come. If we go back basically 40 years ago, we see the top 10 companies in the market really dominated by energy and oil. We come through to, and it makes up maybe just over 20% of the market. We come through to today, and it's basically big tech, really, at the end of the day. And the assets approaching, not quite near, but approaching 40% of the index. And so we've seen that, right? In the Magnificent Seven, the performance of the big tech-oriented companies, they've dominated the markets. And that's been driven in part by things like artificial intelligence. So we like to take a pause and sort of look at our long-term themes. This report was recently updated. Remember, there are 5. We have the fourth industrial revolution, that's really around tech innovation. Securing strategic resources, that's thinking about energy, food, water. Shifting demographics, especially longevity, how population shifts, age, all that change kind of affects things. The new consumer is really recognizing that consumption's done in different ways. And then productive competition is really around whether it's between countries or companies, that competing actually makes us better. In any event, woven all through this is artificial intelligence. And that, as I've said before, has had a big impact. We penned an article in our Outlook report, and basically, gets into all kinds of different applications of artificial intelligence. We're moving from sort of testing and kind of playing with capabilities and ideas, really all the way to implementation. And we're just seeing this across various industries, companies, and that's very important. The idea of sort of an expectation of increased productivity and efficiency and ultimately earnings when it comes to AI and its impact on businesses. And, when we look at the data, we've talked about this before, but profit margins remain healthy. Earnings growth is expected to be certainly higher than the long-term average. So good numbers supporting an equity market. And actually, when we look back at 2025, we looked at this last month, we saw dominance in non-U.S. indices and big tech. So think Magnificent Seven and NASDAQ, for example. That meant those cap-weighted indices, like the S&P 500 or Bloomberg 1000, dominated, as I showed you, by these big tech-oriented companies, had positive numbers. When we neutralized those to equal-weighted, those indices not quite as good, but still positive. And then when we layered in quality, yield, these are indices that had still positive returns, but muted compared to these others. And what we talked about then, and as part of our outlook, is this idea of the market broadening out. And so one of the reasons we think about that is this valuation. We're basically seeing the market remain richly valued by standard measures like PE against its 10-year average. But when we neutralize that and go from the cap-weighted version to the equal-weighted version, things normalize. They're a little bit calmer. So that was another sort of data-driven rationale for a broadening of the market. And ultimately, what we've seen is some of that starting to happen. Now, I do want to pause and say, hey, one of the things we've noticed with this artificial intelligence, I mentioned at the beginning, that there's a lot of optimism, there's a lot of action, but as capabilities are stood up, if specific sort of functions are announced, this company has implemented an AI agent to do such and such, what we're seeing is the industries around such and such. So think financial services, for example, or software. These are areas where there's almost like a scare, and people start getting worried about the effect of AI on those industries. And stocks have been moving down sort of in unison only to kind of calm down and typically recover a little bit. And again, there's still stuff that needs to be worked out. But we've noticed it's almost like emotional trading. And so it's like sell and work on it later. We penned an article, which again you can check out via the link on this page, that basically talks about staying the course on process, which is don't sell indiscriminately, but rather do the work. Look at the company, look at their business, and understand their fundamentals, and then make a decision: buy, hold, or sell. And so we just think that idea of taking a breath, having the discipline is super important. In any event, this idea of broadening basically has shown itself so far this year in the market. So think of the patterns I showed you a moment ago almost being reversed. So we've got still non-US doing pretty well. The big tech companies have gone down a little bit. The cap-weighted indices are just very modestly positive as of this year-to-date date that I have here. But then the equal-weighted indices much better. The quality and yield-oriented stuff much better still. And so just think of it as that idea of broadening and sort of the reversing that we talked about. And it's early in the year, but it's shown itself so far here in 2026. Now, I always like to reiterate when it comes to our outlook that we are mindful for a lot of reasons. Geopolitics, maybe some kind of external event, or this worry about AI could drive us to a more negative direction. We frame that up in what we call our bear case in the Outlook report. So we did it against AI, the issues around AI, the consumer maybe slowing down, and maybe policy errors with the Fed or fiscal policy errors with the federal government. And yet we also acknowledged in that report the flip side of that, which is the bull case. Maybe people are overly worried and things end up being much more positive. Maybe the consumer remains super engaged, and we're kind of leaning in that direction when it comes to outlook on the economy, and that policy is well managed. So again, just acknowledging that possibility of a range of outcomes here with that modestly positive base case view looking forward. So anyway, I want to just close by the invitation I always make, which is to go to stifelinsights.com if you want to check out this work and a bunch of other things that the team and others do more broadly here at Stifel. We're really pleased to bring this work to you. Thank you so much for spending the time on this session, and hey, we'll see you in March. Thanks so much.